Hey everybody, welcome back to Drawbridge Finance. Today we're talking about the risks associated with high dividend yield return. Welcome back to Drawbridge Finance. My name's Levi Woods and this is an opinion channel about money. I thought I'd take a few minutes to sit outside because it is a glorious spring day on this Good Friday here in Vancouver, British Columbia. And there's been something that's been ongoing on my channel that just drives me crazy. And I thought this would be the perfect time to address it. Because a lot of people seem to associate a high dividend yield with higher risk. People make comments all the time. They think that if a stock is yielding a 7% return, then it's automatically higher risk than a stock that pays a 2% dividend return. And I want to show you guys that is entirely untrue. I've set up a little spreadsheet and I want to go through it today. I've made a really simple chart. Now, these are the expected dividend payouts from two theoretical companies. We're going to look at Alice Inc. and Bob Inc. I've put a company valuation of $20 million on each of these. Each company has a total of 4 million publicly traded shares, and they trade currently at a share price of $5. These two companies are equal in the respect of the valuation of the company, the number of shares, and the value of the actual stock per share. What varies drastically is the difference between Alice Inc., which pays out 38 cents per year, compared to Bob Inc., which pays out a dividend of 13 cents per year. This gives Alice Inc. an annual expected dividend yield of 7.6% return. Gives Bob Inc. a 2.5% return. People comment all the time, there must be higher risk involved with Alice Inc. It's paying out an expected dividend payout of $1.5 million, while Bob Inc. is only going to pay out a third of that. They're going to pay out $500,000 in dividends. But we can't just look at those numbers. We have to look a little bit further at their balance sheet. Let me load up another little chart for us to look at. This is their gross income. In the year, both companies are going to have $10 million worth of income. But where their companies differ, Bob Inc. is going to spend $4 million on payroll. Alice does the same $10 million in sales, but she does it with a payroll of only $2 million. She also has a smaller facility, so her rent and utilities are only $1 million compared to Bob's, which are $2 million. Other than that, their companies are identical. They both earn $10 million, as I said before. They owe taxes of $1.8 million. They spend about $1.2 million on advertising, and they have shipping costs of $500,000. Their net expenses are drastically different. Because Alice operates with less employees and in a smaller place, her net expenses are only $6.5 million, where Bob's net expenses are $9.5 million. Which gives Alice a net income of $3.5 million, where Bob only has a net income of $500,000. Now let's look at their expected dividends that they're going to pay. Alice is going to pay out $1.5 million in dividends, and Bob's going to pay out $500,000. His company's only made $500,000, and he expects to pay out the entire $500,000 in profit, which is great, except what that gives him is a 100% dividend payout ratio. Alice, on the other hand, pays out $1.5 million in dividends, but she's also going to keep $1.9 million in retained earnings, which she can use to either grow her business or she can keep it in cash. She can use it for other things. So her dividend payout ratio is 43%. So to calculate this, we're using the dividends that she pays divided by the total net income. So Bob, you can see his 100% payout ratio is $500,000 in dividends paid divided by the net income of $500,000. Alice's is 43%. So if we look at that in a pie chart, you can see pretty clearly that Alice has $3.5 million in income. She's only paying out 43% of that in dividends. She's got this retained earnings of 57%. So if her profits for her business suddenly start going down, she can easily continue to pay out this dividend by using some of the money that she would normally keep in retained earnings. Bob, on the other hand, if his company starts to suffer at all, he actually has to borrow money in order to maintain his dividend. So his 2.5% dividend yield is actually at a much higher risk than Alice's. I've built another chart just to kind of give you the scale of it. Remember, both these companies make $10 million a year. Bob's got $500,000 that he pays out directly in dividends. Alice is paying out $1.5 million, but she's got just this huge amount, almost $2 million in cash. What this means is looking at the dividend payout ratio is way more important to us as investors. I want to look for a company that has a healthy amount of income that they can use to continue to pay their dividends. I wouldn't touch Bob Inc. at all in this situation because his ratio is way off. He's paying all of his income out to shareholders. Although that seems great at first, I mean, it just is risky business. So in this case, investing in Bob Inc. is a much higher risk than investing in Alice Inc. because of this dividend payout ratio. I hope this video helps clear up any confusion that there might be around dividends and risk. If you guys have any questions or comments, please leave them below. Let's get rich together.